Hey there, welcome to the part 8 of our online session. In this video, we are going to understand a magic formula that comprises of risk management and position sizing. I made this formula for myself when I was struggling in my beginning to mid trading phase when I understood what needs to be done, but I was not able to replicate it in real market. So that is when I came up with some formula, and this is that formula we are going to understand today. So what is that formula anyways? So formula is a set of numericals which is divided into four different parts. So we'll understand that. So the formula is 2050131. Now what is this? Don't get confused. I'll make you understand everything. So this formula is basically divided into set of four parts of risk management and position sizing. So what is it? So the first part is 20, the next part is 50, the next part is 13, and the last part is 1. 20 here means that you have to take 20 trades in a month, maximum 20 trades in a month. So you have to take maximum 20 trades in a month. What does that mean? Why 20 is the number? Why didn't choose 30 or 10? Well, 20 is a number because what I'm trying to imply over here is that you should be doing quality trading, that you should be focusing on quality trading, not on quantity trading. So whenever you do quantity trading, your trades usually go beyond 30 or 40 in a month. So that is what we have to avoid, and we have to look only for the quality trades that our setup says to trade. Like it is absolutely fine if you do not get any trade for 2 days, but whenever you get that quality trade, it is your duty to punch that trade, no matter how hard it is to punch at that particular moment. So 20 trades in a month, maximum 20 trades in a month, meaning that you have to only focus on quality trades. 50 is accuracy. 50% is basically what I'm trying to imply over here. So 50 is basically 50% accuracy. So I'm not taking 30 or 60 over here. I'm just trying to be in somewhere in between. 50 is basically very achievable accuracy. And with good technical knowledge, with good uh, analysis, you can even achieve 60% accuracy with ease. But I'm not going 60 just as of now. We'll understand that later. But for now, we are keeping it to 50%. 13. So 13 is basically what I'm trying to imply over here is the risk reward ratio of 1 is to 3. 13 is basically the risk reward ratio of 1 is to 3, meaning for every 1 rupee that we are risking, we are going to take a reward of at least 3 rupees. And the 1, as you might have guessed, is basically 1% risk. So maximum 1% risk on any given trade. So this is how the formula is 2050131. So it might sound very simple, or you might say it's very easy to make such kind of formulas, but trust me, this works wonders in live markets. So before we understand how to interpret this formula, let me ask you one question. If you have a capital of 1 lakh, what is going to be your expectations from market on a monthly basis in terms of percentage? Like if you have 1 lakh capital, what are the percentage terms return you are going to expect from market? Now let me tell you, the hedge fund managers and the professional traders aim not more than 2 to 3% a month. All right. So how much are we going to expect from markets? 200%, 300%? No, that is what the usual mindset of every retailer is, and that is why so many people lose money in markets. So let's be realistic. We cannot aim for 2 to 3% because we will never be able to grow from such capital. We cannot be aiming for 200 or 100% or 50% as well, because that would be just basically gambling. Because to aim a 50% return on a monthly basis, you cannot risk 1%. You will have to risk somewhere between 15 to 20% per trade to achieve that kind of return on a monthly basis. So with 1% of risk on a one trade basis, how much can we really expect to achieve? Somewhere between 5 to 10%? Isn't that realistic? What do you think? According to me, if we aim somewhere between 5 to 10% on a monthly basis, we will do good in markets. because this capital starts to compound over time, and after, let's say, 3, 4, or 5 years, you will have a huge sum of money in your hand. So to aim 5 to 10%, let's see how stuff works out with this particular formula. So let's say 20 trades a month with 50% accuracy basically means you're going to win 10 trades and you're going to lose on 10 trades, isn't it? Because 50% accuracy, 10 winners, 10 losers. Now this is where this 13 and 1 thing kicks in. The risk reward is basically what changes the game for you, because on the winning trades that you're going to win and losing trades that you're going to lose, there's so much of difference that it makes up for everything. Like on the 10 losing trades, you're going to lose how much? You're going to lose 1000, that is 1% risk, because 1% risk on 1 lakh capital is 1000 rupees, and 1000 multiplied by 10 losing trades is basically 10k. So you're going to lose 10,000 on your losing trades, but when you win, you're taking a profit of 3000. 1 is to 3 risk reward. So 3000 multiplied by 10 is going to be 30,000. And this is absolutely realistic. This is nothing that you cannot do in markets, because 1 is to 3 risk reward ratio is pretty much achievable if you stay patient in winning trades, and if you cut short your losers with just 1% risk or even below that. So our winners are going to make us 30,000, our losers are going to take 10,000 from us. So that, where are we left with? We are left with 20,000 gross profit. Now what is gross profit? Gross profit is basically the profit which does not include the tax and brokerage yet. So we have to give 2,000 to tax and brokerage, because we roughly lose around 10% of our gross profit in that. So we are left with 18,000. Now, if you calculate 18,000 on 1 lakh capital is 18 damn percent. Voila. You did not expect that, did you? This is how the formula works. This works wonders. Now, you might say, hey, Shrish, it will not work as you are saying as of now, because there's a difference in analyzing stuff in theory and actually replicating in live markets. I completely agree with you. I completely agree with you. So that is why just chuck 18%. I would say, why not 10? I would say just forget 18. You would still be able to do 10,000 now. Like let's say on some trades you take 2.5%, 1 is to 2.5 risk reward. On some trades you lost more than 1%, like 1.2 or 1.3. Considering all the live market scenarios, 18,000, chuck 18,000, I would say. How about 10,000? You can easily make 10,000 if you could replicate or try to replicate this formula in live markets. 10,000 is easily achievable. And what 10,000 is of your capital? It is 10%. 10% on a monthly basis literally means that you're going to double your capital every 10th month. Every 10th month. And that is also, I'm talking on simple interest basis, because I'm considering the fact that you're going to take away this 10,000 from your capital. If you keep it there, then you're going to compound your capital even for faster. So this formula works actually wonders when it comes to markets. So let's tweak this formula a little bit to understand more of it. So let's say instead of 1 is to 3, what if we do the formula as 2, 0, 5, 0, 1 to 1? What if we take the risk reward of 1 is to 2 and keep the rest of the things same? So what happens is, on the winning trades that you are winning 20,000, because 2,000 you are taking profits and 1,000 you are losing. So 20,000 is your winning trades, what winning trades are giving you, minus 10,000 from losers. So you're left with 10,000 minus 2,000 brokerage, which comes to 8,000. And then we can say that, hey, 8,000 is good. But again, as we say, there's going to be difference of practical execution and theoretical execution. So let's consider that you end up with 5,000. What is bad? What is bad with 5,000? It's good, isn't it? But the thing is, the higher your risk reward is, the better it would be for you to actually grow your capital and gain confidence as well. Because when you win big, you get a lot of confidence. When you win on a smaller basis, it does not give you confidence to go big in the markets. So to 5,000 or 5% is not bad at all. But to gain that confidence from markets, I am keeping that 1 is to 3 as risk reward ratio. Now let's tweak it a bit further. So let's say if someone is having an accuracy of 60%. Now there are people who are having accuracy of 60%. It is not impossible. Just a little bit of knowledge and time into technical analysis, and there you go. You have 60% of accuracy. So someone who is having 60% of accuracy, and the guy who with 60% of accuracy is also taking a risk reward of 1 is to 3, is going to make gold out of markets. Let's see how. 2060131. So if you are doing quality trading and if you are having 60% accuracy, which is pretty much achievable, and then if you are taking a risk reward of 1 is to 3, then let me tell you, you are going to get gold out of the markets. Let's see how. So here it means that uh, on the winning trades, you're going to win 12 trades now because your accuracy is 60%. And when you're losing, you're going to lose 8, isn't it? Because the accuracy increases. Here, it completely changes everything because earlier it was 10-10 and now it was 12-8. So the difference is huge now. On the losing trades, you're going to lose 1000 multiplied by 8, that is 8000. On the winning trades, though, you're going to win how much? 3000 multiplied by 12, that is 36,000. So remove 8,000 from 36,000, you are left with 28,000. Remove taxes and transaction and brokerage. Let's say 3,000 over here because our gross profit is almost 30K. So you're still left with 25,000, dude. That is 25% of your capital. Now let's see. Let's say that okay, there's going to be this again theoretical difference and practical execution difference. So let's cut the crap. Let's put it to 17% or 18%. Isn't that achievable? Even if there's going to be some kind of difference in theoretical and practical execution, there's not going to be so much of difference that it's literally going to cut into half, na? So from 28, you will still be able to make 17, 18, or at least 15% a month. Even if you make this kind of return in a month, you're going to double your capital on every sixth month. Isn't that good? It is absolutely insane. Now, I am not advising this for someone above, 20 lakh capital because on a 20 lakh capital, you do not need to risk 1% in the first place. You can risk 0.3, 0.4%. I am talking this for people who are having less capital, 50,000, 70,000, 1 lakh, 1 lakh 20,000, 1 lakh 50,000. For this formula is basically for retailers. This is not for institutional players. This formula is for you guys, so you can perform better with smaller capital. And once you start to double your capital, you start to get that confidence. And once you start to get that confidence, the confidence is what we all need. Once you start to get that confidence, then you become unstoppable. So this is how the formula operates. This is just absolutely amazing, works absolutely wonders when you are when you at least try to put this into perspective into live markets, because the first thing itself is very difficult for so many people to do only 20 trades a month, because so many people are busy punching 3 and 4 trades every day that it is literally impossible for them to stay patient enough to punch only 20 trades a month. So the 20 is just a limit because it is just a symbolic representation or numeric representation that you should be doing quality trades. You should be only punching quality trades, not quantity trades. So the first problem starts over here only, that you have to stay very much patient. If you're not able to stay patient in the first place, then this is not going to take place. So you need to learn to stay patient. You need to learn to discipline yourself to be patient in front of markets. Now, there are two types of patience. First type of patience is basically when you are not getting any trade and then you have to stay patient. And the second type of patience is when you are into a trade, your trade is a winning trade, and then you have to show patience. So these are basically two different types of patience. Because whenever you are not into markets, whenever you are not into any active trade, you get fear of missing out thing. You get the FOMO thing whenever you see anything going up or down. Hey man, I could have made money on this particular move. Hey man, I could have made money on this particular down move or up move. And all sorts of things start to come in your mind. So you have to stay patient and disciplined to not punch any trade until your setup tells you to. And then when your setup has finally told you to enter into one particular trade, then you have to be patient enough and give the markets time to work to actually let your winners become the biggest winners. And if it's going wrong, if it's going against you, then make sure to cut out when your stop loss is hit. If you are hoping that, hey, my stop loss is hit, but I can hope that it can reverse around and give me profits, then you are in trouble. You are in deep trouble. If your stop loss is taken out, you have to understand that you have kept stop loss over there for some particular reason. And when that reason is not valid anymore, the reason because you were into the trade in the first place, when the reason is invalid, then you have no right to be in that trade. You have no business to be in that trade whatsoever. And if it's going to be a winner, if it's going on your side, in your favor, then don't cut it out immediately thinking that this might turn into a loser, because markets love to play around with your emotions. So like when you go long, or whenever a trade is going into your favor, let's say plus 500, plus 600, plus 800, at this point you might feel, let me take out my profits and let me just save those profits out. But don't do that. Give markets time. Now, what happens is market most of the time reverses from where you think you should be exiting to play with your emotions. So, like at plus 800, you do not exit and the markets will start to come down. It will start to gobble your profits again. From plus 800, you will see right in front of your eyes the market is going a plus 700, plus 500, plus 400, plus 250. So, you might start feeling that, hey, I missed this complete move. I should have booked my profit at 800. Instead of just letting the markets gobble my profit. And then what happens is you book whatever you have in your hand. Like you book at plus 200 or plus 300, the market then reverses back again and then goes to plus 100, plus 1000, plus 1200, plus 1500. And then you are like, oh, why did I exit? I should have held. I know that this was a winning trade. I know my stop loss is there. I know I have my stop loss in place. If it goes against me, I have no issues. I'm just going to lose my 1%. But I entered into a quality trade and then made a premature exit. So this is again a problem. So you need to have that patience before you punch a trade and after you punch a trade. So you need to have that patience in the first place. Otherwise, this is not going to work. Once you show the patience, 50% accuracy is pretty much achievable. But then again, the 1 is to 3 risk reward ratio is where the patient thing comes in. You have to stay patient when you are into winning trades, and you need to show that discipline to the markets, because the market does not reward you for your intelligence. It does reward you for your patience and discipline. And again, the last thing is very important, because you might say, hey, I am looking into quality trades, I'm taking and punching quality trades. Why should I take only 1% risk and not 2 or 3%? Because what happens is it is we who decide this is going to be a quality trade for me. It is not anyone is telling us, or market is coming from above and telling you that, hey, this is going to be quality trade. It is just our thinking process. It is just us. It is just us who are deciding this is going to be a quality trade or this is not going to be a quality trade. So we basically do not know that this is for sure going to be a quality trade. There's no 100% guarantee that this is going to be a winner. So because we do not know, we have to act in terms of probabilities. We have to think in terms of probabilities that anything can go wrong. No matter how good or how high probability trade this is, this can take my stop loss. And that is why you have to limit your risk to 1%. All right. So this is how this formula works, and it works absolutely wonders when you start to take higher risk rewards and when you start to improve your accuracy. Accuracy is still fine, I would say, because with 50% accuracy also you can make a lot of money. But the thing is over here. The main thing is over here that you have to show patience and discipline when you are winning to win big, and you have to show that discipline to cut out on short when you are losing. So I hope you have understood this particular formula. Try to understand it, try to interpret it, try to apply it in real markets, and then see the magic with the results that you are going to get. So in next video, again, we have a surprise for you. In next video, we are going to understand how to understand the upcoming move of Nifty. Now, this is again, I have not included in my context. So this is going to be very amazing session, because in that particular session, we are going to have a look at various factors that contribute to movements of Nifty and how you can analyze the upcoming move of Nifty by using those factors. So stay around, and just if you're not clear about this concept, then make sure to watch it again. It's this is a recorded video, so you have no issues watching it again. No problem spending time out there, but get the concept cleared because the concept clearing is more important. All right, so I will see you in the next session, guys. Until then, bye bye. Take care.